Imagine waking up one morning and seeing silver jump from around $80 to over $150, maybe even $280. Sounds impossible, right? But the strange thing is, the math actually supports it. Not speculation, not hype, simple numbers. Recently, the markets showed something unusual. Oil spiked dramatically, gold surged and crashed within hours, and silver briefly touched a major resistance level before pulling back again. At first glance, it looked like chaos, but behind that chaos is a hidden pattern most people are missing. A pattern involving the strength of the dollar and something called the gold to silver ratio. And when that pattern finally breaks, silver could move faster than anyone expects. Right now, silver appears stuck. Prices move up slightly, then quickly fall back. Traders see these small daily fluctuations and assume the metal has lost momentum. But the real issue is not silver itself. It is the environment surrounding it. One of the biggest forces affecting precious metals today is the strength of the US dollar. Whenever uncertainty rises in global markets, investors rush toward the dollar as a safe haven. That demand pushes the dollar higher, and when the dollar strengthens, metals like gold and silver often struggle to maintain upward momentum. We saw this play out recently. Oil surged dramatically during geopolitical tension, briefly pushing toward extremely high levels before quickly reversing. Gold followed a similar path. It opened strong, climbed sharply, and then dropped hundreds of dollars in a short time. Silver also attempted to break higher, but was rejected at a critical resistance level. From the outside, it might look like precious metals are weak or unstable, but the reality is very different. Silver is not failing to rise because investors do not want it. It is being restrained by macroeconomic pressure, especially the strong dollar. Think of it like a runner trying to sprint against strong wind. The runner still has strength, speed, and endurance, but the headwind prevents forward progress. This situation has repeated again and again in recent months. Every time gold and silver attempt a strong rally, the dollar surges and slows them down. But history shows that this dynamic never lasts forever. Currencies move in cycles. There are periods when the dollar dominates global markets and periods when its strength fades. When that shift happens, assets that were previously held back suddenly gain momentum. Silver has historically been one of the most explosive assets during those moments. The problem today is that most investors are watching daily price charts instead of understanding the deeper structure of the market. They see small price moves and assume nothing important is happening. But beneath the surface, the setup for silver may be building towards something far bigger. And to understand that possibility, we need to look at a specific indicator that has predicted major silver moves for decades, the gold to silver ratio. The gold to silver ratio is one of the most powerful indicators in the precious metals market, yet many investors completely ignore it. This ratio simply measures how many ounces of silver are required to buy 1 ounce of gold. If the ratio is high, it means silver is relatively cheap compared to gold. If the ratio is low, it means silver has gained strength relative to gold. Right now, the ratio is sitting around the low 60 range. That means it takes roughly 60 ounces of silver to purchase 1 ounce of gold. Historically, that number has moved dramatically during different market cycles. In strong silver bull markets, the ratio falls quickly because silver begins to outperform gold. During weak periods for silver, the ratio rises. What makes the current situation interesting is that the ratio has been trending downward since its extreme peak several years ago. That peak represented a moment when silver was heavily undervalued relative to gold. Since then, the chart has formed a long structural pattern: lower highs, lower lows, and a clear downward trend. But now something even more important is happening. Two massive trend lines that have been forming for over a decade are converging. One originates from earlier silver bull market lows, while the other descends from the peak of the ratio during global crisis years. When two long-term trend lines meet, markets often reach what analysts call an inflection point. At that moment, price cannot remain trapped in the middle forever. It must break in one direction or the other. If the ratio breaks upward, gold will likely outperform silver. But if the ratio breaks downward, as many indicators suggest, silver could accelerate dramatically compared to gold. And that is where the math becomes fascinating. Because once you apply realistic gold price projections to a falling gold to silver ratio, the resulting silver prices begin to look extraordinary. Numbers like $150, even $280 per ounce, suddenly appear through simple calculation. At first, those numbers sound unrealistic. But once you see the historical patterns and understand how the ratio works, they begin to look much less extreme. To really understand why silver could experience a powerful move in the future, we have to step back and look at the bigger picture. Markets rarely move randomly for long periods of time. Beneath the daily headlines and short-term price swings, there are usually deeper forces slowly shaping the direction of an asset. In the case of silver, one of the most important forces is its relationship with gold. For decades, gold and silver have moved together through different economic cycles. Both metals are considered stores of value, Both react to inflation and currency changes, and both tend to attract investors during times of uncertainty. But even though they move in the same general direction, they do not move at the same speed. Gold is usually the leader. When global markets, security. Because of that reputation, gold is often the first metal to respond when inflation rises, currencies weaken, or geopolitical tensions increase. Become unstable, large institutions, central banks, and wealthy investors typically buy gold first. Gold has thousands of years of history as a reserve asset, and governments themselves hold it as part of their financial. Silver behaves differently. Silver is both a precious metal and an industrial metal. It plays a role in electronics, solar energy systems, batteries, medical equipment, and countless modern technologies. This dual identity gives silver a unique position in the market. It is not only influenced by financial demand, but also by real-world industrial consumption. Because of that combination, silver often lags behind gold during the early stages of a precious metals rally. Investors initially rush toward gold because it is seen as the safer asset. Silver usually moves more slowly at first, which sometimes leads people to believe that it is underperforming permanently. But history shows that this early lag is often temporary. As a precious metal cycle develops, something interesting begins to happen. Once gold has already moved significantly higher and confidence in the trend grows, a second wave of investors starts paying attention. So these investors often look at the price of gold and think it is already too expensive. That is when silver suddenly becomes attractive. Because the price per ounce is much lower, many people feel they can buy more of it and potentially see greater percentage gains. The shift in attention can create powerful momentum. The silver market is much smaller than the gold market. That means when the same amount of investment money flows into silver, the price impact can be much stronger. A relatively small increase in demand can push prices upward very quickly. This effect has been seen multiple times throughout history. During previous precious metals, bull markets, gold often started the rally, but eventually silver caught up and then moved faster. When that happened, the gold to silver ratio began falling rapidly because silver was gaining value faster than gold. In one historical cycle, silver surged dramatically in a very short period of time, while gold continued rising more steadily. The result was a major compression in the ratio between the two metals. Something similar happened again years later during another metals rally. Gold climbed first, building the foundation for the move. Then silver suddenly accelerated, producing large percentage gains within a relatively short time frame. This pattern is not accidental. Silver's smaller market size, combined with its industrial demand and investor interest, makes it highly sensitive to shifts in capital flows. When enthusiasm for precious metals spreads beyond institutions and reaches everyday investors, silver often becomes the metal that moves the fastest. Another important factor is supply. Unlike gold, which is mostly stored and preserved, silver is constantly being used in manufacturing and technology. When silver is used in electronics or solar panels, much of it does not return easily to the market. Over time, this means available above-ground supply can shrink relative to demand. When industrial demand continues growing while investment demand also rises, the supply balance can tighten quickly. That tightening can create pressure that eventually pushes prices higher. In recent years, global industries have expanded their use of silver in advanced technologies. Renewable energy, especially solar power systems, relies heavily on silver components. At the same time, electronics manufacturing continues to grow as the world becomes more digitally connected. These trends suggest that silver demand could remain strong for years to come. Meanwhile, investors have also become more interested in physical precious metals as a way to protect their wealth against inflation, currency instability, and financial uncertainty. When those two forces combine, industrial demand and investment demand, the result can be a powerful shift in the market. But markets rarely move instantly. Instead, they tend to build pressure slowly before a large move occurs. Imagine a dam holding back water. For a long time, the pressure builds behind the wall, but nothing appears to change from the outside. Then eventually, the pressure becomes too strong and the water bursts through. Silver markets can behave in a similar way. Years of gradual accumulation, tightening supply, and rising demand can create a situation where prices suddenly move much faster than people expect. This is why experienced investors often watch long-term indicators instead of focusing only on daily price charts. Those indicators sometimes reveal structural changes before they become visible in price action. The relationship between gold and silver is one of those indicators. If gold continues rising while silver begins to catch up and outperform, the ratio between the two metals can fall quickly. And when that happens, silver prices can accelerate dramatically. The important point is that these moves rarely look obvious in the beginning. Early in the cycle, silver may appear quiet or even disappointing compared to gold. But if history repeats the patterns seen in previous precious metals cycles, silver's quiet phase may simply be the calm before a much stronger move. Now let's focus on the numbers, because this is where the entire argument becomes much clearer. Instead of relying on opinions or market hype, We can use a simple relationship that has existed in the precious metals market for decades. That relationship is the gold to silver ratio. As explained earlier, the ratio tells us how many ounces of silver are needed to buy 1 ounce of gold. When the ratio is high, silver is relatively cheap compared to gold. When the ratio falls, it means silver is gaining value faster than gold. Right now, the ratio sits roughly around the low 60 range. That means it takes about 60 ounces of silver to equal the price of 1 ounce of gold. Historically, however, this number has often moved much lower during strong precious metals bull markets. In several past cycles, the ratio dropped toward the 40 level. In extreme silver rallies, it has even moved closer to the mid-20s. Those historical numbers are important because they give us realistic scenarios for where the ratio could move if silver begins outperforming gold again. Now let's combine those ratio levels with potential gold price targets. Many analysts believe gold could continue its long-term upward trend as global economic uncertainty, inflation pressures, and currency concerns remain present. Suppose gold eventually reaches a level around $6,000 per ounce during a strong cycle. If the gold to silver ratio at that time were around 40, we could estimate the implied silver price by dividing the gold price by the ratio. 6,000 divided by 40 equals 150. That calculation suggests silver could trade near $150 per ounce under those conditions. This is not speculation or prediction. It is simply the mathematical result of combining a gold price with a historically reasonable ratio level. But there is another scenario worth considering. During particularly strong silver markets, the ratio has compressed even further. If gold reached around $7,000 per ounce and the ratio fell to approximately 25, the calculation changes dramatically. 7,000 divided by 25 equals 280. In that case, silver would be priced around $280 per ounce. Again, this number is not based on guessing. It comes directly from the relationship between the two metals. The reason this relationship matters so much is because silver tends to move faster than gold once momentum builds. Gold usually attracts large institutional buyers first, but silver often becomes the focus when the broader investment community enters the market. Because the silver market is smaller, strong demand can push prices upward at a faster rate. Another factor supporting this possibility is the difference in supply dynamics between the two metals. Gold is rarely consumed. Most of it remains stored as jewelry, coins, or central bank reserves. Silver, on the other hand, is widely used in industrial applications. Over time, the consumption removes part of the supply from the market. When industrial demand combines with investment demand, the available supply of silver for investors can tighten quickly. If that happens during a period when gold is already rising, the ratio between the metals may compress even faster. Of course, markets never move in perfectly straight lines. There will always be corrections, resistance levels, and periods of consolidation along the way. Price movements can pause or reverse temporarily before continuing their broader trend. However, the mathematical relationship between gold and silver provides a useful framework for understanding how large silver moves can develop. By watching both the price of gold and the direction of the gold to silver ratio, investors gain a clearer view of where silver could potentially go if historical patterns begin repeating again. In the end, the numbers themselves tell the story. When gold rises and the ratio falls at the same time, silver's potential price increases become far larger than most people initially expect. Now the real question becomes, how far could this move go? Some investors believe silver will simply follow gold gradually. Others believe a powerful rally could occur if the ratio compresses quickly. History shows that silver markets can surprise people because the market is relatively small compared to other asset classes. Strong investment flows can create rapid price movement. This is why many experienced metals investors focus less on short-term price swings and more on structural indicators like the gold to silver ratio. But opinions vary widely. Some analysts believe silver could reach $150 during the next strong cycle. Others believe $200 or higher is possible under the right conditions. And of course, there are also skeptics who think those numbers are unrealistic. That is why understanding the math behind the ratio is important. It allows investors to form their own conclusions based on data instead of emotion. So now I want to hear your perspective. Where do you think the gold to silver ratio could go in the coming years? Do you believe silver could outperform gold significantly, or will the metals move more slowly than many expect? Share your thoughts and calculations. Different viewpoints help everyone understand the market better. Let's come back to the key idea. Silver may look quiet on daily charts, but the deeper structure of the market tells a different story. A powerful relationship between gold and silver has existed for decades, and that relationship is measured through the gold to silver ratio. Right now, that ratio is approaching a critical point after years of gradual change. If it continues moving downward, silver could begin outperforming gold in ways that surprise many investors. Simple math shows how dramatic those moves could be. Gold at $6,000 with a ratio of 40 produces silver at 150. Gold at $7,000 with a ratio of 25 produces silver at 280. Those numbers are not predictions. They are mathematical possibilities based on historical patterns. Whether the market eventually reaches those levels remains to be seen. But one thing is clear. When the gold to silver ratio shifts significantly, silver rarely moves quietly. And if history repeats, the next major move in the silver market could be far bigger than most people expect. So keep watching the ratio, because it may reveal the future of silver before the price charts do.